Well, it has been quite a year when it comes to the economy and retirement. So many changes, and we want to thank Garrison III from Preservation Financial Group for being with us every week to sort of keep us up to date on everything that is going on. And he is back again to sort of continue a conversation that a lot of people had some interest in that we talked about a couple weeks ago, and that's medical savings accounts. And Davis, Happy New Year. Good to have you on the show.
Happy New Year. Thank you for having me.
It's been quite a year as we look back and now looking forward, and so many things. And that's one of the things I really enjoy about you coming on the show is you sort of take a look at what's happening and bring it down so we can all understand it and keep up with it.
Well, I try.
And now we want to talk about something we started talking about a couple weeks ago, and that's medical savings accounts and sort of the tax benefits when it comes to those.
There is a recognized expert. His name is Ed Slott. He's a CPA, and he is considered the guru of IRAs. And right now, for pre-retirees, especially baby boomers, their biggest concerns are high deductible medical savings accounts, and medical prices are going up constantly, and also how to minimize the taxation from their rollover IRAs, from their 401ks, traditional IRAs, that type of thing. And Ed has a, I'd call it a technique to address both of these. And what you can do is, if you have a high deductible medical insurance plan, which is not hard to find.
I was going to say most people are going to those.
That's
most
exactly
companies
right.
are going to those.
That's exactly right. And what Ed recommends that you do is take a withdrawal after you're 59 and a half, because prior to 59 and a half, there's a 10% penalty if you withdraw from a qualified IRA.
Okay.
But take a deduction from that IRA. All right, that is taxable income. In that same year, make a contribution in the same amount, and do not withhold any taxes from your IRA, but make a contribution to a health savings account in the same amount. And right now, today, and you know everything's in a state of flux right now, but right now, today, an individual can contribute $4,350 a year to HSA, and a couple can contribute $7,750 a year. And the beauty of that is that the IRA distribution is taxable income, but you get a deduction for your contribution to the health savings account. So you're turning what Ed calls a tax-infested IRA into a tax-deductible health savings account.
And the beauty of the health savings account is it doesn't expire. You can continue to roll it over year after year.
And say you do it at 59 and a half, you'll be able to do it for 6.5 years. And what that means over a 6.5 year period for a single person, $28,275. For a couple, over $50,000.
Wow. Big difference.
It's a big difference.
Well, we thank you so much for your information. Thank you for what you bring to the show, and great to have you. Best of luck in 2017.
Thank you.
As we look forward.
Same to you.
Everybody your information. It is Preservation Financial Group, and you can find Davis right there on Sunset Drive, right here in Johnson City.
The preceding portion of Daytime was sponsored by